Okay. Great. So let's review and finish up this chapter. So again, we're learning about the balanced scorecard, which we talked about a bit, right? It's an approach some companies use to evaluate their performance, where finance is only one of 4 dimensions that they look at. And then there are other aspects of performance evaluation that we looked at as well. So we talked about why, right? Why we need to evaluate performance of individual employees, managers, departments, business units. We need to make sure that everybody's working towards whatever is the company's objective, right? And the way you motivate people to do that, if they're not self-motivated, is you need to make sure that their individual goals are going to support the company's goals. And you might need to have certain incentives or rewards that are important to them that get them to do what's important to the company, right? That's the overall concept. The company is looking to expand, typically increase revenues, decrease costs, whereas individuals, we're looking for increased compensation, increased opportunity through promotions. Oops, what did I do there? Wrong button. All right. Let's see. We don't need to get into those details. We worked through different examples, talked about what goes into an effective performance management system. Okay, and then we got to ROI, which we were already familiar with, right? Return on investments. So it could be your return divided by your investments, but another way to look at it is whatever income you've earned divided by the assets you invested to get that income, right? So it's really the same thing, just slightly different wording. And then I talked about how you can slip sales revenue right into the middle of that formula, and you break it down into sales margin, income divided by sales revenue, and asset turnover, which is sales revenue divided by average capital assets. So now you get not only ROI, you get kind of sub measurements within ROI. And if you remember, you could take your sales margin, multiply it by your asset turnover, and it will equal your ROI. We see the relationship here. So again, for this chapter, we're saying the return is your income and the investment is your average capital assets. If you're trying to remember what does that mean, your income, well, one way to define income would be revenue minus expenses, right? Just like on the income statement. And your average capital assets is just your fixed assets at the beginning of the period plus your fixed assets at the end of the period divided by 2, right? So you've got those 2 formulas here that you can refer to. We looked at this bakery, right? And we looked at these 3 divisions. And this one's making the most income. But does that mean it's doing the best job? Hard to say. Maybe not. Until we dig in a little deeper, we see what is their ROI, right? What is the relationship between their sales revenue and their income? What is the relationship between their sales revenue and the average capital assets? So the more we look from different angles, the more complete the picture becomes, right? And we can see how it's really doing. So then we got to residual income. Bless you.
Thank you.
So that also is something we were already familiar with. What is your income, your profit, your return, whatever you want to call it, minus whatever you had to invest and then times the minimum required rate of return that is specified by the company. So the only difference between this and the previous version we learned was we used cost of capital. So we're just replacing cost of capital with minimum required rate of return. And here was an example of that. If a certain investment gave us a return of $250,000, great. But we take what we had to invest to get that, times that required minimum rate of return, subtract that from the return, negative number, not good, right? So we should not actually do this. It does not meet our minimum required rate of return. So that would be one way we could screen out that particular investment. And then just to clarify, this would probably be an annual return. So if we're investing 1.5 million, we know we're not going to get that back right away, right? But if we're getting back at least our minimum required rate of return, then it's a good enough investment and it will pay itself off over time. Okay, you might remember that one. I don't want to revisit that one, if that's okay with you. Then we talked about EVA. This is a new concept, economic value added. And really the main difference between this and residual income was what? Well, actually, I guess there are two differences. How does this differ from residual income calculation? We start with after-tax income instead of pre-tax, right? And instead of multiplying by the minimum required rate of return, it's the weighted average cost of capital. And the way we do that, we take the cost of capital for debt, cost of capital for equity. We don't, in this chapter, we don't have to calculate that, but in real life, you might have to figure that out. And we multiply it by what percentage of the capital is coming from debt, what percentage is coming from equity. So those two percentages would logically add up to 100%, right? Because those are really the two options. So then you take the cost of capital for debt times what proportion of your capital is made up of debt, and you get this weighted cost of capital. You do the same thing for equity. You add them together. That is your weighted average cost of capital, which is this part of the formula. Okay. Once again, if you end up with a negative number, that's a sign you do not want to do that particular project. Are there questions? That was as far as we got. And I said we wanted to be fresh when we tackled this particular activity. Any questions before we do this? Okay. Okay. So here we get to apply all these different concepts. We have these 7 different steps. The first one, let's just start with the first one so it doesn't seem too overwhelming. What is the sales margin with and without the new machine? So the company's thinking of buying this new machine, right? Now, the formula for sales margin is simply your income divided by your sales revenue. So what we have to do here, let's see, let me do it like this. I'm just going to try to make it as large as I can. And I'll just write directly on the screen. That should work. Okay. What is the sales margin with and without the new machine? So if we look down here, we see, and again, we need income divided by sales revenue, right? So let's start with income. The income without the machine is $7 million. With the machine, it will be an extra million, which would mean 8 million, right? 7 plus 1. So to do our two calculations here, let me see if I can fit it in here. I'm going to put with, we'll do with first. So we have 8 million income. Oops. Always do that. I forget to turn on my number lock. Okay. Income of 8 million. And without, we have income of 7 million, right? Then divided by sales revenue. So we look down here, sales revenue with the machine is 19.4 million. And without is 18 million. Everybody see that? Down here. Okay. And then we just divide. So 8 million divided by 19.4. And you probably know this already, but I don't have to type out 8 million divided by 19.4 million. We could just do 8 divided by 19.4 and it would give us the same answer, right? So let's save ourselves a little bit of hassle. So with the machine, I got 41%. And without the machine, 7 million divided by 18 million, 30, just say 39%. Okay. So now we can see the sales margin is higher with the machine, a little bit lower without the machine. Make sense? Okay. Let's go on to number 2, sales revenue divided by average capital assets. Well, we just saw the sales revenue, right, was 19.4 with the machine. If it's going to fit here, we'll try. 4 million. Nope. Okay. That's all right. So 19.4, and then we have to divide it by what? Yep, average capital assets. Okay. And so we're saying with the machine, what are the average capital assets? Here it says beginning of the year capital assets without the machine is 8 million. And then end of the year without the machine is 8.4 million. But we want with the machine, right? Well, the cost of the machine is $2 million. So we just add that to the other assets. That means we have beginning with the machine is going to be 10 million. Without, at the end of the year, it's going to be 10.4. Averages out to 10.2 million. Does that make sense? Okay. And let's see what that comes out to. 19.4 divided by 10.2, 1.9. That is our asset turnover. And then without. So the average capital assets, the sales revenue was 18 million without the machine, right? And we divide that by what? Again, our average capital assets. Without the machine, we're averaging 8 million and 8.4 million. Averages out to 8.2 million. 18 divided by 8.2, 2.2, which is better than 1.9, right? When in a turnover ratio, you want a higher number. So far, we had a better sales margin with the machine, and we have a better asset turnover without. right? So far. Okay. Then ROI. Well, we could take sales margin and multiply by asset turnover, or we could just take income, divide by average capital assets. Let's do that. It'll be a little more precise, probably, because of rounding. So 8 divided by 10.2, right? Because that was our income with the machine. That was our average capital assets with the machine. So we have an ROI with the machine of 78%. And without, what would we divide by what? 7 million income, right? Tell me if I get any of this wrong. Divided by 8.2 average capital assets. That would be an 85% ROI. We can double check it. Let's double check it. So if we go with, we take 0.41 times 1.9. Yeah, basically 0.78. And then if we take the 0.39 here times 2.2. Okay, yep, we're in the right ballpark there as well. So obviously, 85% is a better ROI than 78%, right? Okay, making progress. Residual income with and without the new machine. So let's see, income with the machine, we said was 8 million. With 8 million. And then we need to subtract average capital assets times the minimum required rate of return. So we said with the machine, the average capital assets was 10.2 million. The required rate of return here is 15%. 1,530,000. So 8 million minus 1,530,000, 6,470,000, right? I'll put 6.47. No. I'll just let's see. What was it? 1.53. I think that's what it was. So there's our answer. There is our residual income with the machine. And then we have without. All right. What is our income? It was 7 million, right? Average capital assets, we said were 8.2 million without the machine. And again, the rate of return is 15%. So we're subtracting 1,230,000. $5,770,000. So we'll call it 5.77 million. All right. Well, 6.47 million is better than 5.77 million, right? So it looks like for residual income, the machine came out better. One more, EVA, after-tax income. How do we get after-tax income with the machine. Would be our income minus 1 minus the tax rate, right? Our tax rate is 30%. So another way to look at it would be our income times 70%. That's how much we get after taxes. Okay. So 8 million times 0.7. So 5.6 million. That is the after-tax income with the machine. But then we have to subtract the average capital assets times the weighted average cost of capital, right? Which we said average capital assets with the machine is 10.2. Weighted average cost of capital is 9%. I do that? Yeah, 10, yeah, times 9%. So 918,000. And let's see what that comes out to. 4,682,000. Okay, compared to without the machine. Again, we take our income, we multiply it by 70%. So that's going to be 4.9 million. Then we subtract from that average capital assets without the machine, which was 8.2 million. Did I use 10.2 on the last one? Or 8? I did, good, okay. So 8.2 million times 9%. $738,000. 738K equals 4,162,000. Okay, which is less, right? So the EVA is better with the machine. So we've done it. We've crunched all the numbers. The sales margin is better with the machine. Asset turnover is better without. ROI is better without. Residual income is better with the machine. And so is EVA. All right. So what do? Do we buy the new machine? How many people would say buy the new machine? Okay. Couple. How many say don't buy the new machine? Okay. So what would be the argument in favor of buying it?
Less risk of it breaking down.
The latter?
Less risk of it breaking down.
Okay, it's true. Newer machines are probably going to be more reliable. Okay. We see better sales margin. We see, what's that? Residual income is better. Yeah. Without the machine though, you know, I could see going either way. Maybe we do need to look at some non-financial considerations. Maybe we need to double check my calculate. I mean, we're not going to do it now, but very possible I might have messed up some of those calculations. And we'd have to think about what is it we're really trying to achieve here, right? If what we care about is ROI, we're better off without the machine. It's sticking with the current one, right? We're concerned with residual income or EVA, we're better off with the machine. Last question here. Oops. How would ROI be affected if the invested capital were measured at gross book value before depreciation? So in other words, if our asset values are higher, what then happens to ROI? It goes down, right? Remember how depreciation, which lowers your asset value, increases your ROI? So higher assets decrease ROI. Okay, so that was quite a chore. I say let's move on. Okay, balance scorecard. We talked about this a little bit during the exercise set, right? And it's used so the companies get a view of how the company's performing beyond just the financial. Every company should know their finances, right? But if you take it further and do the balance scorecard, what you look at would include the internal operations. Are we getting more efficient and producing better quality products? Are we learning and growing as an organization? And what is the customer perspective? How do they feel about the company and the products? So the balance scorecard assesses all of these. And mostly it's non-financial, maybe even non-quantitative in some cases. Financial, as you know, you can measure with ROI, residual income, EVA. Also earnings per share, which you might remember from financial accounting. That's particularly important to investors. They want to know what kind of earnings the company earns per share of stock. Revenue growth, sales growth, inventory turnover, those would all be financial measurements, right? To look at the internal perspective, the operations of the company, it would be things like how many defects do we produce? How much are the machines down? How efficient are the transactions? Well, how much time do they take, for example? How many products are completed per day per employee? All of those really are not financial, right? They might have financial implications, but the way you would measure it would not involve dollars and cents. The customer perspectives, are customers satisfied? Do they come back and continue buying? Are we getting new customers, and how many of those are from referrals? And how much market share do we have? What percentage of this particular market of customers did we attract? And learning and growth. So that's kind of a broad category. It could include employee suggestions that we adopted, employee turnover rates. Are people sticking around or are they quitting? Hours of employee training, the scope of process improvements, the number of new products. So all of that would go under learning and growth. So how do you use that information? You can use it at multiple levels. For example, here we see a balanced scorecard for the company as a whole. So you could say, you see the four categories here, right? The four dimensions of the balanced scorecard: financial, customer, internal, learning, and growth. But within each of those, notice you've got some specific business objectives related to each of those dimensions. And then here it specifies how you're going to measure the performance and what the target is, what you're shooting for. So that's quite a bit, right, to look at. It gets into quite a bit of detail here. Now that's for the corporation as a whole. You can also apply it to an individual portion of the business. Like here is one particular division. Again, we've got all four dimensions of the balanced scorecard with specific objectives, specific ways you're going to measure performance, and specific targets. And you can even take it down to the level of the manager or even the employee. Now, what is this employee expected to do to help with the financial, the customer, the internal, the learning and growth dimensions, right? So it's a time-consuming process to identify these objectives and these targets and to track them, and then to analyze the performance and to sit down in meetings and talk to the employees. It would take quite a bit of time, but some companies find it's worth it. And it helps the organization, really be more prosperous and successful. So that is the balanced scorecard approach. Questions or comments? All right, let's see how. Ooh, almost break time, which is good because we're almost done here. Let me give me a second here. See how much more we have to cover. Oh, last slide before the summary. So what we would do here, if we had a little more time, is we would brainstorm some non-financial measures for each of these different types of companies. For example, for a grocery store, what are some things you could measure that would not be financial that would tell you about the performance? Like, how full is the parking lot? How many customers are standing in the return line, right? How clean is the store? How long is the line for the cashier? So these would be examples. And we could think through various industries, but since we're a little pressed on time, let us quickly summarize this chapter. And then, and we only have 2 problems left, don't we? Did them all. I think there were only 6, and we already did 2 of them. Okay. Let me, I think it's 5 and 6. Oh, yeah, I remember what those 2 are. They're probably going to take us about 10 or 15 minutes. I'll tell you what, let's do this. Let's go ahead. I'm gonna save this. We will go ahead and take our break. We'll come back in 10 minutes. And then we'll definitely be done early. I can promise you that. All right, so see you at 2:50. Okay, so this is where we left off. As I was mentioning, we could go through these different industries and think about what would be some ways we could measure their performance that are not financial. For example, hospitals, what is their recovery rate, right? Or auto manufacturers, what are their safety records? What are the emissions of their vehicles, right? So there are many different non-financial measures we could use in different industries, which is part of managerial accounting. Is that a question? Oh, I'm not displaying. Thank you, Obed. I see it, but you don't see it. Thank you. Yeah, so that is part of managerial accounting, right? Most of what we've done this semester dealt with costs, which are financial, but some aspects of managerial accounting are not financial. So let's review what we have covered this chapter. We've been talking about performance measurement systems, how the goal of the individual, whether it's a manager or an employee, should be congruent with the goals of the organization, right? So whatever they are incentivized to do actually benefits the company. They should only be evaluated on things that they can control, obviously, because they would be frustrated if that were not the case. There are financial measures as well as non-financial. Some of the financial measurements would be ROI, residual income, EVA. And then if we're applying the balanced scorecard, in addition to the financial perspective, we've got the internal operations of the organization, customer experience, and then learning and growth, right? Okay, so we are officially done with the chapter. And